So the first question that we are working out goes like this. The following is the balance sheet of ABC Limited as on 31st March 2020. Calculate the current ratio, quick ratio, and absolute ratio. And they have given us the balance sheet. Using this, we will have to calculate the ratio. So let's start solving this. So we are already familiar with the formulas. And the first ratio that we are going to be calculating is current ratio. Now we know that current ratio's formula is current asset divided by current liability. So current asset divided by current liability. So we have to calculate what is the current asset. So let's go back to the balance sheet and let's see which are the items which qualify for current assets, which are the items which qualify for current liabilities. Now, we know that current assets are those assets which can be converted into cash immediately. So let's look at the assets at first. Fixed asset, no, this is not a current asset. Stock, yes. Debtor, yes. Bills receivable, yes. Prepaid expenses, yes. And also this we will have to consider exclusively when we work out the quick ratio. Cash at bank, yes, it's a current ratio, it's a current asset. Cash in hand, that is also a current. Now let's go look at the liability. Share capital, reserves and surplus, creditors, yes, this is a current liability. Bills payable, yes. Bank overdraft, yes. Outstanding expenses, yes. Provision for taxation, yes. So these are the current liabilities that we have. So now let's just quickly add up all these items and see how much is the current asset, how much is the current liability. So on the asset side, we have 50,000 plus 20,000 plus 15,000 plus 5,000 plus 30,000 plus 20,000. Okay, so that will work out to be 1,40,000. So 1,40,000 is your 1,40,000 is your current. That is your current asset. So current asset is equal to 1,40,000. Then you have current liability. Now current liabilities, which are the items that we will take as current liabilities? You have to consider creditors, 20,000, then 20,000, 20,000 plus 5,000 plus 17,000 plus 8,000 plus 20,000. Okay, so that is current liability. So current liabilities is 70,000. Now let's calculate the current ratio. So current ratio is 1,40,000 divided by 70 divided by 70,000, which makes it 2, which gives the answer 2. Okay, so this is current ratio. So we've completed the calculation of current ratio. Now what we have to do is we have to calculate quick ratio. Quick ratio, how do we calculate? Quick ratio is quick asset divided by quick liabilities. Quick asset divided by quick liabilities. Now, how do we calculate quick asset? Quick asset, we know quick asset, the formula is current asset minus stock plus prepaid expenses. So let's just quickly work this out. Current ratio is 1,40,000 minus stock is how much? Stock is 50,000. Stock is 50,000. Then you have prepaid expenses. Prepaid expenses is 5,000. So let's sum up all this and let's come to the let's calculate what is the answer. So 1,40,000 minus 55,000, that is 85,000. So 85,000 is your quick asset. Then we have to calculate the quick liability. So quick liabilities is current liabilities minus bank overdraft. So current liabilities includes current liability is 70,000 minus bank overdraft. How much is bank overdraft? Bank overdraft in the question is 17,000. Okay, bank overdraft in the question is 17,000. So that has been completed. So 70,000 minus 17,000, that makes it 53,000. So 53,000, and let's calculate quick ratio. And quick ratio is 85,000 divided by 53,000. 85,000 divided by 53,000, and that gives us an answer of 1.603. So that is the answer. Then we have to calculate the absolute ratio. Now absolute ratio, how is it calculated? Absolute ratio is calculated as when we go back to the formula, it is cash plus marketable securities. Now in our case, we do not have, in our question, we do not have any marketable securities. We have cash. So cash, what we have is cash at bank and cash in hand. So 30,000. Okay, so this is so let's revisit the formula once again. This is the formula for this is cash plus marketable securities. The cash plus marketable securities, the whole divided by current liability. So cash is cash in hand and cash in bank, which is 50,000 divided by current liability is 70,000. Okay, 70,000, and let's just calculate this. So this is 0.714. 0.714, and that is your absolute ratio. So with that, we have completed the computation of current ratio, quick ratio, and also absolute ratio. Now let's also just quickly look at the interpretation. Current ratio is 2, which means the company enjoys a good liquidity position. We also see that the absolute quick ratio is more than 1, that is also fine. An absolute ratio is something close to 0.75, which is also fine. So this company is enjoying a very good liquidity position.